Markets experienced a pullback here on Thursday. In particular, we had a bit of a rough final hour of trading today, so that didn't feel too good. Felt a little heavy going into the close. In fact, I would also say that the Russell 2000 chart looks downright ugly right now. The other indices giving back a few of their gains that they got a little bit earlier this week, so maybe not as concerning there, but the small caps still have a lot of work to do. So we'll take a look at those charts as we always do and try to determine where our posture is from an intermediate perspective. Of course, tomorrow is a big CPI number day, and so we'll get a read on inflation, and we'll see how the market responds to that, which has been a little bit of a hot button issue here more recently. Near the end of today's video, I then want to show you a trade application example where I focus on a bearish trade setup where we short sell a stock in the hopes that it falls further into the future. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 9th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down below into our description area where you can sign up for our email distribution list. That way you can be notified whenever David and I post these videos. Remember, those emails will also contain the overbought and oversold cluster signals from the S&P 500 stocks at the bottom of the emails. So give you an extra perk there to open up those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. Would encourage you to click like and retweet if you want us to do these videos as often as possible. You guys have been doing a great job with that, so thank you. And also we have a presence over on Facebook, so feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. I got to get moseying along here. For those of you that follow me on Twitter, you might have seen that we got some snow here in the Salt Lake Valley. For those of you that aren't aware, David and I both live in Utah. I'm more in the city area, whereas he's out in the country, but nonetheless, we're kind of getting a little bit of a late start, apparently, to our winter, but we got our first snow today, so I've got to quickly get out there and shovel the driveway before my wife get home. So anyway, let's get through the presentation here tonight and see what we can learn from stock market analysis perspective. So you've got the heat map pulled up in front of you for the S&P 500. And you can see that it's kind of an opposite looking heat map than when I was with you on Tuesday. Remember, that was the day where we had a lot of outperformance from the heavy hitters in the growth arena. Today was kind of the opposite. Notice that a lot of those same growth-oriented mega caps that were really carrying the market on Tuesday were the exact opposite ones that were kind of faltering here today. Notice in particular, of course, Tesla really stands out as being one of the few trillion-dollar companies. It was down 6% here today. Just barely hanging on to that $1 trillion market cap, as you can see there. Another day like this, and it probably won't have much of a $1 trillion market cap, but of course, one of the most successful growth stocks that we've seen in this current era. So those Cathie Wood stocks seem to once again go on sale here today. I saw she was on CNBC earlier today doing some interviews, but those types of innovative and growth-oriented names. We talked a lot about the CRISPR stocks, as a matter of fact, in my question and answer session today, for those of you that are premium members and want to hear my insight on that topic. But of course, she's heavy into those CRISPR stocks and all those other types of disruptive and innovative companies, and they've been absolutely clobbered here in recent months. And so that is kind of a way to take the temperature of the risk appetite of the market at any given moment in time. And it does seem like that is one of the missing elements of this market, where a lot of those types of disruptive growth companies just are not participating here on the upside the way that we saw them participate on the upside in the early part of 2021, whereas we are still seeing stocks like Apple kind of track higher. Today they were down just a touch, 0.3%, but Apple is obviously very close to all-time highs, and that's not necessarily a disruptive growth company anymore the way that it might have been perceived a decade ago. It's more of a juggernaut and a cash-flowing machine these days. So there are kind of different ways to examine those tech companies out there, and it does seem like the big, bulky, mega cap, cash-flowing tech is still holding holding up reasonably well, but underneath the surface, the disruptive, innovative tech that oftentimes is not profitable at this juncture, those companies are getting smashed right now. So not necessarily the best environment for stocks in general when that is the case. You do see NVIDIA was down today tremendously as well. It was down 4.2%. You also had Adobe down 3%. AMD was down about 5%. We did have some good news after the bell in terms of those semiconductor companies with Avgo. You're not going to see it here because this is referring to the normal market session, but Avgo is up about 5 or 6% as we speak. That's Broadcom to be official. I sometimes refer to it as Avgo because that is the ticker symbol. It used to be Avago, and they retained the ticker symbol of the old company, but renamed the combined company Broadcom just to confuse everybody. So anyway, that company not only is up handsomely on their earnings announcement after hours, but they jacked up that dividend another 14%. Some of you saw me tweeting about that. That's been a company that we've purchased multiple times in my dividend growth investing class over the last 5 years or so. And just in the last 5 years, it's doubled its dividend income, and its share price itself has tripled. So it's been a true home run. It doesn't get talked about a whole lot compared to Apple and Amazon and some of these others, but that has been a really strong performer over the years as well. So some good news for those of you that might be Broadcom shareholders there after the bell tonight. Now, in terms of what areas of the market seem to be working a little bit better here today, you can see that it was a lot of those consumer staples types of companies. Notice that Walmart was up, Procter & Gamble was up, Berkshire Hathaway was up just a touch. We had AbbVie and Johnson & Johnson and Pfizer, right? Some of those older school pharma companies. We also did have a nice bright spot in the form of CVS. Again, some of you that follow me on Twitter would have seen me tweeting about this already, but just as a heads up, CVS did raise their dividend today, and normally that's not that noteworthy of an event, but in this particular case it was. CVS had been a very strong dividend growth investing stock for many, many years. They had a streak of I want to say 15 years in a row of increases up until about 2017, and it was around that time that CVS, this is the drugstore company here in the United States, mentioned that they are buying Aetna, the big health insurance company. And at that time, the management team said that we are going to freeze the dividend, effectively keep it at the same rate going forward. So not cutting it, not raising it, but keeping it flat for the foreseeable future while they digest this massive acquisition of Aetna. And so that was way back in 2016, 2017. So here we are, 4 years later or whatever it's been, and they finally have decided enough's enough. We're going to start raising that dividend again. So great to see that. That was actually one of the first stocks that we purchased for our dividend growth investing class when David and I started Market Scholars, even though we had a history of buying that company when I was with TD Ameritrade previous to that as well. So some of you that have been with me for a long period of time and may still hold CVS in your account, you might be applauding that move by management today. They were up about 4.5% today, partially on that raised dividend news. We also saw a nice day out of Hormel, another dividend aristocrat company in that particular case, like a Johnson & Johnson and AbbVie. Aristocrats are companies that have raised their dividends for more than 25 years in a row or more. Hormel in this case is up about 4.7% today off of a nice earnings announcement. That's actually a company we have in our current dividend growth investing portfolio here at Market Scholars. So, this was a day where it was definitely a risk-off type of a feeling towards this day, where you see a lot of those aristocrats like your Walmarts and your Procter & Gamble's, your Hormels, your Lowe's, your McDonald's, Johnson & Johnson, AbbVie, those types of aristocrats, old school companies, blue chips that were doing reasonably well as kind of a risk-off type of a day, whereas your new tech-oriented names in many cases really did struggle. So a bit of an opposite day from what we saw there on Tuesday. Let's go ahead and take a look at our foregrid now. And as we look at our foregrid here, a reminder that this is chart 4B for those of you that are premium members of Market Scholars following along with your own charting package. Now, as you can see, we had a sell-off day here today for the most part. We were actually pretty much flat there on the Dow Jones Industrial Average. It was down 6 pennies on a $35,000 underlying entity. So effectively 0.00% move if you're rounding. So there was nothing going on there in the Dow. But these other indices, we did have some fairly significant pullbacks. S&P 500 was down 0.72% today. NASDAQ Composite down 1.71% today. And then the Russell 2000 really took it on the chin. They were down 2.27%. Now remember, the Russell 2000 was the one that I pointed out to you on Tuesday that I wasn't overly excited about, right? I was mentioning at that time we were still in that strongly bearish posture despite the 2% move that day, but I had pointed out how far away we were from that falling 30-day moving average. We still had that big kind of air pocket right there, whereas the other indices were all touching their moving averages. So it was a pretty obvious moment where the small caps were definitely a laggard in this market. Yesterday, we did have a follow-through day to a degree. We finished a little bit higher on the Russell 2000. It was actually enough to get that green line out of that lower reversal zone. So the background color of the chart did shift from that dark pink to light green, telling us about that posture change. But here we are one day later, and it looks like it's unwinding in a big way. Notice how terrible that candle looks. Not only was this the worst performer of the day, down over 2%, but we basically closed at the low here today. We were only 2 pennies off the low when it was all said and done. Anytime you're closing at the lows of the day, particularly when it's an aggressive day like it was today, notice the label on the daily range on the Russell 2000 is orange as opposed to these other ones in blue on the other charts. That's telling us that today's range was more extreme than the average true range here more recently. So it was an above average aggressive day, and on top of that, you close at the low of the session. It's basically giving you the hunch that had the market been open another hour or two, we likely would have fallen even further, at least on the Russell 2000. So not a good end to the day for a lot of these indices. Again, the Dow Jones kind of got lucky there, being with a lot more of those blue chips, of those aristocrats that I mentioned before. But the other indices, they had a pretty heavy close, and it wasn't a really good feeling, right? Because when you're looking at the S&P 500, you'll notice that it still does have that strongly bullish posture with that dark green background color there, as that green line on the intermediate line on the market forecast crossed up and through that chart's 50th percentile. So that one is okay, but even that, it's a little bit of a shame that we were only 1% or 2% away from hitting an all-time high that exists still from November 22nd, and it kind of gives you the impression it's rejecting that, right? It's kind of rolling over here. I don't want to, necessarily write its obituary because we are still above a rising 30-day moving average. So you kind of have to give it the benefit of the doubt, but it was not a good look there at the end of the day. NASDAQ looks even worse because it's back below its moving average, right? We talked about that on Tuesday as well, how the S&P 500 looked to be this market's leader at this moment in time because of how it was easily able to get up and through its moving average, whereas the NASDAQ Composite basically stalled out at the end of that day right at the moving average. Now, it did go up a little bit today, but again, similar to the Russell 2000, not a good look here because you're fading that bullish move right out of the gate, right? You kind of want to see some momentum kind of bursting higher to kind of build upon as we head into the end of the year, and you're just not necessarily getting that impression right now. There have been choppy markets, without a doubt. It's been tough. You've been kind of chewed up and spit out lately if you've been a swing trader trying to, time these markets. And we've seen that here with our trades as well, so you're not alone. But point is, you kind of want to see more robust price action if you think that we are able to get back to those all-time highs here in the next few weeks, which I still think we have a good chance of doing. So I don't want my somewhat cold blanket that I'm throwing on it today to suggest that it's impossible. I'm just saying that when we see days like this where we close near the lows, it gives you the impression that market participants are not nearly as bullish as they were earlier in the year, where they just couldn't get enough of stocks. They just kept on buying them into the close. Now we're starting to get the opposite impression here. So didn't really like the way that the markets felt at the end of today, despite still us having those intermediate bullish postures on these charts, as you can see. But it's the ultra short-term price that is more concerning to me. Remember, the background colors of the charts are talking about an intermediate time period, talking about months, right? What I'm referring to here of my disappointment is what's been happening in the days, right? The ultra short term. So anyway, I still remain reasonably impressed with the S&P 500 like I was on Tuesday. I will say that I'm a little bit more impressed by the Dow Jones Industrial Average than I was on Tuesday, because I wasn't particularly enthusiastic about the Dow, but it has shown some resilience in the last couple of days, and that's noteworthy. Notice that we do have that dark shaded green background color there, in addition to the green moving average telling us prices above a rising 30-day moving average. So I would say that's kind of moving up in my own mind in terms of its robustness and its ability to be bullish. But I would say that the NASDAQ composite has kind of moved down a peg in my mind from just where we were at a couple of days ago, because I don't like the way that it's kind of rejecting right here at that obvious resistance area that I had mentioned on Tuesday, which is the 30-day moving average itself. Now, we'll just have to keep our eye on it, as we always do, right? That's the whole point of doing these videos as often as we do, is we can kind of check it out on a day-by-day basis as things change. But, didn't like to see NASDAQ selling off by 1.7% here today, closing near the lows and back below that moving average once again. Now, on a day like today, it's natural that we will get some what's known as bullish intermediate confirmation signals. But remember, there's various ways to look at those signals to determine whether they would be considered ideal or not. So let's talk about that a little bit. A bullish intermediate confirmation signal exists when the intermediate line, which is the green line that you see on the market forecast technical indicator, is considered bullish. And remember, the green line can be considered bullish by just simply being in the upper reversal zone above 80, or if it's between 20 and 80, at least rising there. And if it's above the 50th percentile, then we would kind of categorize that as strongly bullish posture as opposed to weakly bullish posture. So as an example, we do have a strongly bullish posture on the S&P 500 right now, because that intermediate line is at 57 and rising. Now, in addition to that, you need the red momentum line in the lower reversal zone on the same day. It's those two things that constitute a bullish intermediate confirmation signal. And you can see here on the S&P 500 that red line is in the lower reversal zone. The problem is that it's so far in the lower reversal zone, it's what we would consider to be at an extreme reading. Notice that the momentum line is at 0.89 and falling. It's not 8.9, it's literally 0.89. In other words, less than 1. It's about as close to 0 as you can get there. So generally speaking, we would prefer to see that red line somewhere between 20 and 5 in those bullish intermediate confirmation signals. When it goes below 5, then it sets up the possibility that there is more pain on the horizon. So we want to keep our eye on that possibility. So is there a bullish intermediate confirmation signal there? Yes. Is it ideal? No. Another reason why it's not ideal is notice that that blue line is not down below 50th percentile. Right? That's not technically part of that specific trade setup, but we've noticed over the years that in order for that trade setup to work most effectively, and remember what that bullish intermediate confirmation signal suggests is it's a buy the dips mentality, where you're trying to look for a stock or an index that has a bullish intermediate posture. That's what the green line is telling you. And then the red line is telling you that you have a momentary pullback. So you're trying to buy a dip within an ongoing uptrend. So what we like to see with the blue line, although it's not technically part of that signal, is we like to see it between 50 and 20. That tells us that there's been a healthy enough pullback where the dip is worth buying, right? Because, yeah, there's a dip here, but let's be honest, it was only a dip of 0.72% today. Not that big of a deal, right? So if the blue line were to fall further, effectively what that means is that the price is probably going to be falling further as well and give you a little bit better bang for your buck if you're looking to buy the dip there. On the Dow Jones Industrial Average, we also have a bullish intermediate confirmation signal. In this case, the red line's a little bit better for us. Notice the red line is at 14, so it's not below 5, but it's still below 20. So that is that kind of zone that we want to see it in. However, we still have the same problem with the blue line. In this case, the blue line's still in the upper reversal zone. At least with the S&P 500, it was a little bit below that. So again, it exists, but it's not an ideal setup. We'd like to see that blue line between 50 and 20. This is not a major exhale that we are seeing right here. Down below here now on the NASDAQ composite, again, we have the same problem as the S&P 500. We have a bullish intermediate confirmation signal, but notice the momentum line is at 0.72 and falling. It's even lower than the S&P 500. So another extreme reading there that tells us, hey, there could be more to this story. There could be further pullbacks ahead of us. In the case here of the NASDAQ composite, at least the blue line has made a bigger effort to pull back. Notice that we're not quite below 50 like we wanted. It's at 51 right now, but it's at least a deeper exhale there that has taken place, and that makes sense. Notice that the movement is 1.7% to the downside, nearly 100 basis points different than what happened on the S&P 500 today. And then last but not least is the Russell 2000. Technically, you do have a bullish intermediate confirmation signal here as well, but like the NASDAQ, you have a weekly bullish green line because it's not above 50 yet. You do still have the red momentum line at an extreme reading below 5. This is about as low as you could ever see it. It's at 0.02. So could it go to 0.01? Yeah, but you get the idea. That's about as bad as it gets there. And that's because we closed at the low of the session essentially today. And then you also have the same problem with the blue line not being below the 50th percentile yet. So with all four of these charts, we do have bullish intermediate confirmation signals, but with none of these four charts do we have ideal setups. So we'll just have to see how it all shakes out. It's been choppy trading. It's hard to find ideal setups in this environment, and we just have to take what the market's willing to give us. Let's step away and take a look at the internet here briefly. I always like to say thank you to those of you that help support the Market Outlook video that David and I do. A reminder, we don't get paid to do it. We don't make any money on advertising. We don't have any partnerships that we need to pitch products to you or anything along those lines, right? So we do it out of the goodness of our own heart, and hopefully you guys see it that way as well. We try to do it as often as possible, but we do hope that you are willing to kind of get the word out about our organization, because while we don't make money off of these free YouTube videos, we do have a subscription service for our premium members, and the more that we get our name out about our organization, even through a free video like this, the hope is that eventually that results in more premium subscribers as well. So you guys kind of know the drill there. But anyway, anytime we're up and over 100 likes on Twitter, then I will make this free video a priority in my day. When we're below 100 likes, then I just have to check my schedule and see if I've got the 3 hours to commit to doing the video. So for those of you that want to see these videos ongoing and continue to be free on YouTube going forward, we have one request for you. That's a really easy one. Just simply click like for us there on Twitter. There's 4 different ways to go about that process. I happen to be on Twitter right now, so remember, we tend to pin our tweet to the top of our timeline if you're looking for David and I on Twitter. And you can see that 102 of you clicked like for me last time around. So thank you to all 102 of you, including Deborah and Ron and Dennis and Adrian and Saj and Lucius and Valerie and Claire and Prickly Trader and Margie or Margie, sorry, my apologies, Kirk and Dave and Jimmy and Ron and so on and so forth. There's too many to mention here, but thank you. We really appreciate that. It helps a lot, and it helps justify the time that we spend on these videos. So keep up the great work there. Really appreciate that. Also, I wanted to show you our factor selector tool as well. This is one of the tools that I use for my swing trading class on Wednesday morning, so be aware that this is based upon Tuesday night's closing information, which I think is important to note in the context of this conversation today, because one thing that surprised me when I put this together on Tuesday night was the big drop off in momentum stocks. Notice that this purple ball went from number 2 down to number 5, and that's that momentum factor category. Now remember, on Monday and Tuesday, we had huge surges higher in the stock market. Momentum is one of the most exciting factors out there, and it is a way for you to take the risk appetite of the market as well. So I was actually scratching my head a little bit and a little bit surprised that momentum fell that far. Now, I teach a momentum class on Monday for my premium members called Top-Down Trend Trading, and our account value is down a bit over the last month, so I wasn't surprised that it fell. I think I was more surprised that it fell that far, from 2 down to 5, based upon Tuesday night's closing information, where we had very robust price action on Monday and Tuesday. So it kind of just caught me by surprise there. Well, here we are on Thursday, and we had a pretty ugly day in the market today, and maybe that was, the market telling us something, giving us some clues along the way that not all is right in the world. Right now, you can't just go and bet the farm on something like this, but just little clues that you pick up along the way by being part of an educational program like David and I offer here at Market Scholars. So I wanted to point that out in case some of you hadn't caught that from earlier in the week when I posted that there. But we do still have quality stocks leading in this market and the low size category lagging in this market. And given what I just showed you a second ago on the Russell 2000, that should come as no surprise. Remember, the Russell 2000 is essentially a low size factor index, and so it has been struggling comparatively out there. All right, let's get back on track with some other Thinkorswim charts, and let's do some 12 grid analysis starting with chart 5A. Now, as this pulls up, a reminder that the background colors of these miniature 12 grid charts will tell you what the current posture is using that intermediate line on the market forecast. So if the charts are green, that means there's a bullish posture. If the charts are pink, that means there's a bearish posture. So on this first set of 12 grids here, you can see there's a couple of pink charts on the board. One of them is TLT off on the left-hand side here. Remember, that represents long-term U.S. Treasuries. Now, in this one, I'm not so certain I would be anxious to short it. Now, I could be wrong on that, of course. I'm just looking at the charts here. I do think that interest rates will go up over the longer term and bond prices will suffer as a result. But more to the point, what I'm referencing is right here, right now. Do I think that's going to unwind in a hurry? Not necessarily, regardless of what that background color is telling me. Right here, I actually kind of view this as an interesting place to be counter trend if you're willing to. In other words, we've had a big pullback there in TLT, but we are resting right atop that 30-day moving average, which remains rising at this moment in time. So it has me wondering if we're going to catch a little bit of a bounce here in TLT. Now, remember, that would typically happen if there is a pullback in the stock market. Not always, but a lot of times money does rotate from bonds to stocks and vice versa. And investors become more interested in TLT when the stock market becomes a little bit more chaotic. And so if we do have a further pullback in stock prices, that could positively impact something like TLT. So watch for the bounce there moving forward. The other chart on the right-hand side here, Bitcoin, that is much more dangerous, right? That one, as you can see, has that dark pink color, telling us that that is a strongly bearish posture, not a weekly one like we see with TLT. And in this case, we're trading way below that falling 30-day moving average there. Remember, Bitcoin is a speculative asset. I'm not here to say whether it's going to do great over the long term or whether it's going to be a complete scam over the long term. Who knows, right? A lot of things can change in the world. But what we do is we try to look at it from a trader's perspective. What's happening right here, right now? And this particular asset class has fallen out of bed at the same time a lot of those Cathie Wood innovative disruptive companies have fallen out of bed, and therefore there is a high degree of correlation between the two, and therefore you don't really view Bitcoin as an alternative asset that would protect your capital the way that you might think about other things out there, perhaps something like gold or something like that. Now, it's true that Bitcoin has gone up tremendously over the years, so I'm not taking it away from that. But what I'm saying is that when market participants get nervous about the markets, they're not generally going to a highly speculative asset class like Bitcoin. Bitcoin is acting like a bunch of tech stocks right now. And so you are seeing a pretty healthy pullback here. Now the question is, have we pulled back too hard too fast? I think there can be a case made for folks who want to get a little aggressive on Bitcoin We're at 48,000 here all of a sudden. Remember, we were at like 64,000 not too long ago, so it's dropped pretty hard in the last month. But you'll notice that we've got some oversold cluster signals that have started to pop up here more recently. So maybe for those of you that are really brave, this would be an interesting entry point if you've got tight stop losses and different things like that, because you do have at least some indication on the chart that maybe things got a little overdone on the downside and we could have a reversion to the mean rally. It doesn't necessarily mean that we have to go back into an uptrend, but could we get back to this area just below that falling moving average, let's say in the next month or two? I think that's a distinct possibility. You'll also notice that Bitcoin is kind of resting here in real time, just a hair above this resistance zone from back in September 16th time period. We kind of topped out at around that time period. Now we're using that same horizontal area as potential support right here, right? So that idea that old resistance becomes new support once it's broken through, like we saw back in October. So, you're probably a little bit ambitious if you're doing that right now, but it's one of those things where you keep it on your radar, and if you see the bounce taking place, maybe you can use that as your excuse and set that stop loss to kind of play Bitcoin back to the upside. But right now, obviously, intermediate trend-wise, it looks terrible, which is why you have that dark pink background color right there. We did have a little bit of a give back today in Treasury yields. They did fall 22 basis points there. We did end the session on the 10-year at 1.48%. And again, we might see some movement in interest rates tomorrow as a result of the CPI report. You'll notice that oil looks like it's kind of rolling over here, so I don't particularly like the view or the look of oil all of a sudden, right? That was a nice bounce off of that oversold cluster signal right there with that green dot. We had a great move out of that for the last week, but now you're starting to get into that little dicier zone here where it looks like it's kind of giving up the ghost and it's running out of energy. You're kind of getting the same impression out of gold as well, just not quite as violent as a result of it not bouncing as aggressively after its own oversold cluster signal there. So it doesn't have as much to give back at the same time. Both those commodities continue to have falling 30-day moving averages, as noted by that red 30-day moving average there. Whereas the dollar itself, the US dollar, was strong today. It was up 0.35% today, which is a decent day for a big currency like that. And we do remain in this pretty healthy uptrend, right? And I was kind of discussing that either with you on Tuesday or last week, can't remember when it was, but there was a day when that background color was that light pink color. And I said I wouldn't pay a whole lot of attention to that because to me, this still looks like a strong trend for the US dollar. So we're kind of just spiraling at this moment in time, seeing which direction we're going to break out. But given the fact that we're still above that rising 3-day moving average, I think there's a decent chance that the dollar could strengthen here into the end of the year. And remember, that's not always the greatest thing for the market at large. I prefer personally a falling dollar environment. I think that risk assets do a little bit better. So when the dollar firms up like this, you might have a harder time making money in some of your multinational securities that are out there. You can see, speaking of multinational and foreign securities, the EFA, the developed foreign stocks, were down 0.83% today. The emerging markets were down 0.48% today. So developed stocks did worse than the U.S. from a foreign perspective, and emerging stocks did slightly better, but all three of those categories were down today. I happen to notice there was a new IPO from Brazil, a Brazilian bank that has apparently some Warren Buffett backing. New bank, I think it's ticker symbol NU, did their IPO here today, so maybe there was some more enthusiasm around Brazilian securities that helped prop up the emerging markets just a little bit as a result. In terms of any movements from a sector perspective here now, our 12 grid, as you can see, we do have one pink chart on the board. It's not the same one that we saw on Tuesday. So we got a little bit of a difference, a little shakeup here all of a sudden. That chart on the left-hand side there is discretionary. My, oh my. Remember, discretionary was one of the market's leaders here just a month ago. So things have taken a little bit of a toll. Now, keep in mind what I've tried to share with you throughout the years when it comes to XLY, which is XLY is effectively controlled by three securities: Tesla, Amazon, and Home Depot. Everything else doesn't really all that matter that much. So, and I'm taking that a bit too far. But if you look at the breakdown of XLY, because it is market cap weighted, those three stocks really do dominate the price action. So when Tesla is doing really good, XLY is likely going to be doing really good. When Tesla is doing poorly, as we saw today, Tesla was one of the worst performers in the market. No surprise. We also see XLY, the discretionary stocks, doing poorly. They were, I believe, the worst one today. Let me just double check that. Yeah, they were. They were down 1.73% here today on discretionary if you're using XLY. I would also point out that I don't like the look of this pattern over here. Some of you might identify that as a head and shoulders pattern, right? The inverted head and shoulders pattern would be bullish reversal patterns to the upside. This one would be a normal head and shoulders pattern where you would expect a breakdown to the downside if it does play out. Now, obviously, a lot of things need to start clicking in order for that to happen, but that possibility exists. So keep that on your radar for that possibility of a potential breakdown there in discretionary. And if that were to happen, it's probably going to be led by Tesla. And if that's going to happen, then a lot of Cathie Wood's other innovative and disruptive growth stocks are probably going to suffer as well, given what we know about that relationship. So anyway, just keep that on your radar. Doesn't look too healthy all of a sudden there with discretionary. Remember, it was communications that was the prior bearish background on Tuesday. We've actually had a decent move higher in communications in the last couple of days. So that was enough of a movement to switch the posture from strongly bearish to weakly bullish. But I'm not sure how much I trust this one yet, right? Despite the rise in that counter trend move off of that oversold cluster signal there, I'm just not sure because this chart still looks pretty ugly, right? This is still a chart that has lower highs and lower lows, and is still a chart that has a red moving average, right? If you look at all of these other sectors on the board in front of you, you don't really see any other chart that looks that bearish right there. Yes, you do have a red moving average on financials and energy, but they're more recent breakdowns, right? Whereas communications has been ugly for this entire 3 months you see on the chart here in front of you. So give them props, I guess, from the perspective of getting that weekly bullish posture, but I'm not convinced it's going to stick around a long time. We'll just have to see how it shakes out. But anyway, be aware of that change. In terms of any securities that did well today from a sector perspective, you can see that we did have healthcare and consumer staples that were up today. And remember, we kind of knew that when I looked at that heat map earlier. We saw Walmart and Procter & Gamble from the consumer staples up. We saw Johnson & Johnson and AbbVie and Pfizer from the healthcare area. So this was definitely a risk-off type of a day where money was drifting towards more of those defensive characteristic types of assets that are out there, the old school cash flowing businesses. A lot of money got soaked out of the more cyclical and exciting growth areas of the market, as you can see. So the good news is the trends are still holding up. The bad news is we did suffer a bit more wear and tear today, and so you can kind of put this in the category of a win for the bears, I would say, here today, despite the better charts from an intermediate perspective that we've seen as a result of Monday's and Tuesday's big jump higher. So still a precarious market, I would say. Let's go ahead and get into our trade application example now, and I'm going to pull up chart 3A. And I'm going to pull up a company that is pretty well known in its industry, yet might not be all that well known to all of you investors out there. This is US Foods. This is a company that had been private for a very long time and just did their IPO here a couple of years ago. But this is a company, for those of you that have been in my dividend growth investing classes over the years, you're probably familiar with Cisco Foods, one of the biggest food distributors in the United States. And then US Foods right here would be kind of their most direct competition. And so this company kind of caught my eye here today for all the wrong reasons, which, like I mentioned at the in the intro, this is going to be a short selling idea here. Remember, the trade was already done. You guys got your Telegram alerts on that if you're a premium member of Market Scholars while the market was open today. But this chart kind of looks like it's rolling over here. Now, whether it ultimately rolls over enough for the trade idea remains to be seen, but because it did close near the lows of its day, at least we do have some gains built into this one right out of the gate. Remember on Tuesday, I did the bullish trade setup on that alternative energy/utility company, and I said, I hope that doesn't do me in. And what I was referencing was the fact that in the last 15 to 20 minutes or whatever of the trading day, that particular stock had pulled back and I was bullish on it. Well, wouldn't you know, we got stopped out of that one. This one's kind of the opposite. This one you almost feel like you got the momentum going in your favor because you did the trade earlier in the session, and then you continue to see positive profit results on this as this stock continued to fall and basically closed at the lows of its session here. So this particular trade is known as a short sale. I'm sure most of you are well aware of that terminology, but for those of you that might be newer to the markets, effectively what you're doing when you're short selling a company is you're borrowing shares from somebody else at your brokerage. You don't know who it's going to be. You're just knowing that you're short selling it, and you're borrowing shares from somebody else who's loaning them to you. So you don't actually own the company, but you can sell it, which is kind of a weird concept for some people, that you're selling something you don't actually own. So in this particular case, you're actually hoping that the stock falls. And what you want is to sell something at a high price and buy it back at a low price and capture the difference between those two levels. So it's kind of the opposite of when you're buying a stock, right? You want to buy a stock low, and if you're going to sell it high, and you capture the difference between those two levels. So you kind of flip that around when you're a short seller and you try to sell high first, buy back cheap later. And this particular chart caught my eye just as a result of this stock really struggling here in the last couple of months, the point of putting in these oversold cluster signals here. We've had our reversion to the mean move already, and now it looks like that move could be done with. You had a pretty aggressive move from 30 up here to about 34 in a week, and now it looks like it's rejecting right at that 30-day moving average, which stayed red that entire time, telling us price was below it, and now it's kind of pushing down and away from it, using it as a launch pad lower. And so you can see the background color of the chart changed from blue to pink, telling us that this blue near-term line is now bearish for the short-term swing trading mindset there. And so you can also see that the dotted line of the S&P 500 is a little bit above this company's price candle, telling us that this stock is an underperformer versus the general stock market as well. So anyway, I did a short sale on this one. You do have to have a margin account to do that, and that's what this paper money account is. It's a margin account. So just keep that in the back of your mind that, if you're thinking about this in a retirement account, you might not be able to pull off this type of a trade. But in a margin account, taxable, normal brokerage account where you've already got that capability, then you should be able to conduct short sales. And so I did a bracket order on this, and I put our stop loss up here a little bit above the candle on November 23rd. So as long as it doesn't break out to the upside above that candle, we'll stay in the trade. And the hope is that we get the price target hit down here kind of across these four candles is where I'm targeting with that 1-for-1 reward risk relationship. So kind of a rare bearish trade there to kind of highlight as an educational example for you here today. All right, that'll do it for me. I hope you got some value out of the presentation here tonight. As always, if you did, I ask one simple thing out of you. Just click like for me there on Twitter. You can find the tweet pinned at the top of my timeline. Otherwise, you can use the built-in widget below the video if you're watching it on the Market Scholars website. For those of you that watch it directly on YouTube, remember in the description area under the video, you'll see the link to the tweet in question that we would encourage you to like. And you can also find the link to the tweet in question in the emails that we send you for those of you that are on our distribution list. So 4 different ways. However you do it, is fine. All 4 of them kind of get to the same place in the end. So thank you for doing that. I'll look forward to hopefully seeing you on Tuesday as well. David should be back with you here this weekend as we wrap up trading. And remember, keep your eye on that CPI number tomorrow and see what it means for inflationary assets. And so with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.